All right, we're going to go ahead and get started here. Welcome to our Q4 2024 financial performance webinar. Our speakers today are Ryan Frazier, our CEO and co-founder, Cameron Wu, VP of Investments, Jake Pruchno, our head of operations, and my name is Korin Hedlund. I lead our investor relations team here at Arrived. A quick agenda, so you all have a lay of the land. The team will walk through Q4 2024 highlights, individual property performance, our fund performance, which includes our single-family residential fund and our private credit fund, dividends, share prices. Jake will walk through that, and then Ryan will close us out with walking through what we released in the quarter and then what we have on our roadmap. And then if folks are new here, we jump into Q&A. So feel free to drop any questions that you have in the chat. We will either answer them in the chat or tee them up for after prepared remarks. So we won't be taking those directly during prepared remarks, but we'll be sure to jump in there so you can take a peek. All right, I would love to welcome Cameron up to the stage, and I will see you all during the Q&A session.
All right, thanks, Corinne. And thank you, everybody. If this is your first time joining in, welcome. If you are a repeat attendee, thanks for coming back. So Arrive's the largest platform for investing in residential real estate that's available to both accredited and non-accredited investors. So we're very happy to have you all here with us. We have 413 individually offered properties between long-term rentals and vacation rentals, 48 single-family residential fund properties. So we're getting close to the 500 mark between all properties combined. We have 227 million total invested in the platform. And right now we have 57 active loans in the private credit fund. So here's a spread of the assets. And this was as of Q4. We've added a lot of new loan locations. So as we update it for the Q1 2025 webinar in a couple months, you're going to see a lot more yellow dot locations in there as we're investing corner to corner all across the U.S. in great loans. So we'll be excited to keep you all updated with that. So we're going to talk about some long-term rentals, the Arrived Single-Family Residential Fund and the Arrived Single-Family Residential Properties. So on the individual offering side, first we had an average occupancy of 92.9% for Q4 for those 387 operational properties. By the end of Q4, we actually ended up closer to 95 overall. So it's just, we were leasing up in Q4, and I can go more into those details. But it was actually a very successful quarter. When you would typically have a lower, slower leasing season, we actually did quite well. We had 66 new leases start in Q4. About 50 of those were new leases, new tenants. 16 of those were renewals. With an average lease term of about 15.5 months executed in that term. Now, we usually have longer term leases. This was a strategic choice to not go for the 18 to 24 month leases, because in that slower leasing season, we want to make sure that, if somebody signs in October, we want their lease to be expiring around February. We don't want an October expiration, because if that tenant did happen to move out, the slower leasing season does present challenges. So we wanted to keep our availability to, as far as the attractiveness of how long the lease term people have to commit to a lower term during the slower season. So that's why we have a 15.5 month average executed term in this quarter. But 42 of those leases were above forecasted rent. So we have a pro forma amount that we try to hit. We always reach for a little bit more, and we got it on about 2/3 of them. Within the single family residential fund, really great quarter. So we have about 19 million invested at the end of Q4. In January, we crossed over the 20 million mark. We have 18.5 thousand investors in there, and we had a 99.5% average stabilized occupancy. So at the beginning of October, we were around 95. We had one unleased property. It leased up, and we stayed occupied at 100% the rest of the time. So if you were to go to the SFR, the fund page, we're at 100% occupancy right now. We've been there since the end of October. We added 2 rental homes to the fund in Q4. So every quarter we add a couple depending on investment volume. But with that more incremental drip in, we're confident that we can keep the stabilized occupancy pretty high for the SFR fund. Next, in vacation rentals, you can see some of our nice properties here. Of note, you can see the buyers that was launched at the end of October. That is the actual home that the buyer's family lived in for a couple of the seasons in Stranger Things. So it's a vacation rental in Fayetteville, Georgia. It's 15 minutes from the Atlanta airport. There's a lot of studios and a lot of shooting that goes on there for different TV series and films. So it's a very cool project, lots of details. So, kudos to the team that put in a lot of hard work to recreate the experience. And it's been very well received by the market. A lot of great reviews, all 5 stars so far, and even repeat guests. There's one particular guest who actually reserved it 3 different times. After they came in the first time, they thought it was so great that they reserved it 2 more times throughout the year. And then you see Sweet Spot and Solano there, which are 2 of our homegrown properties from Arrived Property Management, where we internally executed all of the build out, the purchase, the management. So it's a full soup to nuts property within Arrived Property Management. So for vacation rental operations performance, 660,000 total gross bookings from all operational vacation rentals in Q4, 1,500 total ratings at the end of Q4. We've got 40 bookable vacation rentals. And one stat that I want to call out is that for Arrive Property Management, we had a streak going of 60 straight days of only 5-star reviews. And our host account has a 4.92 rating on Airbnb. So it is a top tier performer and manager account, and really a great testament to a lot of the great operations going on within vacation rentals. And also, we've been slowing down acquisitions in favor of optimizing performance, and we can really start seeing it to shine through with all those great reviews. All right, private credit fund. So this is Arrive's newest investment product. We launched it at the end of May 2024, and it's been delivering a historical 8.1% annualized dividend yield. So there was 26 million total invested in the private credit fund by the end of Q4, and we've maintained that 8.1% annualized dividend. We added 37 loans in Q4, but we also had 36 pay off. So, really starts demonstrating the kind of merry-go-round of loan maturities and then loan purchasing. And it's a very active fund that we're managing here. And so far we have 12,500 investors at the end of Q4, and it's been our fastest growing investment product since we've launched it. Okay, so as far as the investment products, what are our focal points? So on the long-term rentals, and I'm going to kind of group in the single-family residential and the fund together as they're, the same operating plan, just a different security instrument where you individually own the individual properties, and then when you buy into the SFR fund, those 48 properties are all part of the fund. So when you buy in, you're the beneficial owner of each one of those 48 properties. So as we get into the hotter leasing season, going into the springtime, we've stacked all of our lease expirations pretty much between February to June. And this is a very intentional part of our leasing strategy because, as I'd mentioned earlier, when you have people that are moving out, you want them to be moving out during a season when there's a lot of demand, because then we have a higher chance of filling that home back up with a new tenant at a better rent more quickly. So we have a different rent roll construction and lease expiration schedule than a lot of the larger institutions out there, but it's from a lot of experience in the industry to stack all of our leases during that time to optimize occupancy and rate. So we're getting to that time now where we're sending out renewals about 90 days ahead of time. So now we're getting into the May renewal cycles. So it's imperative that we negotiate on price and really try to keep the people in, because even if we have to make some sort of concession on rent, it is much more cost effective to keep a tenant in a property as opposed to having them turn, because there's always going to be vacancy costs, vacancy risks, because kind of the worst stuff happens to a home when it's vacant because you don't have constant eyes on the property. So we're trying to avoid turns as much as possible and maintain that occupancy via our renewal processes. Within the private credit fund, what we're really focused on here is adding new originators with really good product that we can purchase into the private credit fund. Probably since about the end of October, we've put on a $5,000 limit per investor per month. So we've metered the demand to make sure that we have enough loan supply to continue delivering the 8.1% annualized yield, as well as really mitigate our risk for having any sort of bad loans, foreclosures. So we don't want to welcome in any sort of supply into the loan pool. We want to keep a very tight standard to make sure that we don't have any sort of credit losses. So as we're adding originators and adding more of a larger pipeline to purchase good loans into, we'll be slowly changing that max to allow for more investment. That is the goal. But that's what we're focused on for the private credit fund, to make sure that those yields can be maintained. Finally, this was the closing statement from our Q4 blog post about the results, but it's really focused on operations. I felt that 2024, and especially the end of the year, was a really great time where we were optimizing a lot of our operations. Long-term rentals is getting to higher occupancy, where we could then focus on cost saving measurements, renegotiating property management contracts to keep any sort of markups as low as possible. And then on vacation rentals, internalizing all of our, well, not all, but more and more properties in favor of our own property management, as I believe that we can deliver on a better experience for our investors. And then in the private credit fund, continuing to build up infrastructure for originators and building out better reporting assets and merchandising. So you all have a better feel for what types of loans we're purchasing and where and what kind of risk profiles do they have. So with that, I will welcome up Jake to talk through share returns.
Perfect. Thank you, Cam. So now we're going to talk a bit about how all of that operational performance actually translates into returns for investors. So there's two types of returns that you earn when you own real estate. The first is dividends, which is the cash flow that's generated from renting a property out. And then there's the appreciation, which is the change in value of the investment. The dividends are considered realized returns because it's actual cash that's deposited into your arrived account every month, where you can then reinvest that or withdraw it out to your bank account. The appreciation is unrealized because we haven't actually sold the property yet. So you can't really do anything with the kind of estimated change in value of your shares. That appreciation will become realized when we sell the properties and do kind of a final distribution out to investors. And we'll talk about that in just a little bit. The value of the shares that you own while we're operating the properties may be higher or lower than the initial purchase price, but ultimately it's an estimate for right now. And that appreciation will become realized when we finally sell the property. So we'll go first into the dividends side of the equation. The dividends are paid out monthly, so investors are receiving consistent cash flow from their investments. Over the last 3 months, we distributed over $1.8 million to investors, which brings us out to $10 million paid out all time, which is a huge milestone. Also, really cool to see that our dividends in Q4 was double that of our dividends in Q4 of last year and 50% larger than they were in Q2 last summer. There's a lot of growth on the Arrive platform, and we're really excited to hit this $10 million dividends paid out milestone and excited to see where we end up hitting in 2025. Dividends are a big benefit of real estate because you're able to lock in some investment returns now, even while you still look for that long-term appreciation. You get kind of the benefit of receiving that regular monthly income and locking in those returns, even while you still have exposure to the long-term gains in the real estate market. This chart is showing the annualized dividend rate for all of the individual properties, both the single-family residential properties and the vacation rentals. And it's based off of their quarterly payments from the fourth quarter. So it's a good snapshot of the current performance across properties, even if it doesn't fully encapsulate the performance since inception. The important thing here to really remember is that when you're investing into an individual property, you earn the dividends and appreciation based on how that specific property performs. So if you invest only in one individual property, you effectively have all your eggs in one basket. You may end up investing in a property that crushes it and outperforms on rent, doesn't have much in vacancy or other expenses, but you also may invest in a property that has some unforeseen expenses, which causes us to lower or pause dividends in that property temporarily. Now, this is the exact same chart, but we've overlaid the dividends paid by the two funds since their inceptions. The single family fund has nearly 50 properties in it. So if a property isn't rented within the single family fund, it doesn't materially impact the cash flow that fund is generating overall. And that's why that fund has been able to pay out a consistent dividend of 4% every month since it launched just over a year ago now. The private credit fund is similar in that it's a big collection of different real estate loans. That fund has paid out a consistent 8% dividend since it launched last May. Its dividend is double that of the single family residential fund, but remember that it doesn't have the appreciation component of the way that the single family fund does, because the loans that we're carrying don't really appreciate in value, as opposed to kind of owning the equity in a single family home. We hope to have experienced that appreciation over the coming years. Now, speaking of appreciation, we'll talk about the other side of that returns equation. The appreciation we kind of estimate with a share price for each of our investments. And the share price is a combination of the property value, what we think this property is worth if we were to sell it today, and all the other assets and liabilities on the balance sheet of the LLC that investors own. Here's a look at the overall financial performance by each asset type. And I want to highlight a few things on this table. So the 365 individual single family properties that were in operations this quarter had an average dividend of 4%. It's a simple average that combines the brand new properties that are just getting started with our older ones that may have leverage on them or may have had kind of rent increases since they were first launched. The average appreciation change for those properties was down 1.6% over the last 3 months. You can see here that the single family residential fund has the same annualized dividend at 4%. But like I said, that fund is just over a year old and it owns 48 single family properties. The acquisition targets for the fund is virtually the same as the individual properties. So it makes sense that a collection of the properties in the fund is paying out about the same dividend as the kind of aggregated group of all the single family residential properties that were launched individually. Again, here we see that the private credit fund is at that 8% annualized dividend mark. And again, while it's higher than the single family investments, keep in mind that there is no expectation of appreciation with that fund. Nearly all of the private credit fund's returns will come from dividends, whereas the single family investments are likely to have roughly half the returns come from dividends and half the returns come from appreciation. Now we're going to take a quick look at the total gross returns since IPO. This chart is showing the combined dividends and appreciation for all the individual properties. Importantly, this chart is not annualized. So properties that have been owned for a longer time have paid out more dividends and have had a longer time to appreciate. So you can see here that the properties on the far left are hovering around 0% because they've just started paying out their first monthly dividends and haven't even had their first share price update yet. And I want to zoom in particularly here on this dot, which represents the Centennial. The Centennial was the 18th property ever IPO'd by Arrived. And we just sold the property back in October and did kind of the final distribution back out to investors. This was our first property to go through the full investment lifecycle, where investors bought shares in a kind of new offering on the Arrive platform. We operated the property for 3 years and paid out dividends. And then we sold the property and distributed back investors' initial investment plus a capital gain representing the appreciation on the property. It was actually the same tenant that rented the Centennial for 3 years. So we had virtually no vacancy expense on the property. When they gave us notice that they were going to vacate at the end of last summer, we thought we'd analyze the property and see if it made sense to sell. Investors in the Centennial ended up earning nearly a 35% total return over 3 years for an average annual return of 11%. Of that 35% gain, the majority actually ended up coming from appreciation. This month marks the 4-year anniversary of the first properties that we launched to the public. It's likely that over the next year or two, we're going to start evaluating more properties for sale. Especially with these single family residential properties, we have that kind of 5 to 7 year kind of estimated time horizon. And now that we're really starting to hit the early part of that with properties aging into year 5, we'll start to evaluate properties as we see, what the tenancy situation looks like, what the appreciation has been in the local market, and what the returns may look like for investors as we, look to potentially sell the property. And so there may be other properties like the Centennial that you start to hear us announce for potential sales over the next year or two. And with that, I'll pass the baton off to Ryan to talk about what's new and what's coming soon with Arrived.
Thanks, Jake. All right, now that we've talked a little bit about performance in the last quarter, we want to take a moment to talk about what's new in the Arrive product and what investors have to look forward to in the months ahead in the product. And so there's a couple of things that we've launched over the last few months, starting with more dates and countdowns within the app. So for example, in Investors Portfolio page, you can now see the expected next delivery date for things like dividends. And this is really part of our process of just trying to make it as clear as possible when to expect updates from Arrived, whether it's something like a monthly dividend, or things like the further developments on our property timelines that investors have seen month over month, as we're trying to add more and more data to investors. The next is that we've expanded the dividend history in the CSV download. So for investors who really want to go deep into the data around their portfolio, maybe they're now invested in hundreds of properties and they want to look at the dividends or performance across several markets and just want more options to analyze the data. We now have all of the dividend history data in the CSV exports within investor portfolios. So love to hear the feedback on how people are digging into the data and see, what more we can add there. The next piece from feedback from investors is that we now have a monthly breakdown of the dividend history in your portfolio. So if you click into the details around your dividend distributions, we recently launched the cumulative graphs, and in the last month we started to launch a monthly graph for the dividend history, just giving more visibility into the performance of investors' overall portfolios, and again, just more ways to look at the data to inform investors how their portfolio is doing, and perhaps inform new investment decisions that investors want to make. So those are a few of the highlights that we launched in the last few months, and now looking forward, things that we have coming soon. One of the things that we've long heard from feedback from investors that they'd love to see is a geographic view on a map of their investment portfolio. And so we have that planned over the next few months to add that to investor portfolios to be able to see how their investments really play out across the country. We're launching more detailed account statements, so a monthly account statement for investors so that they can see a history of what they own and what happened in their account during that month. And then we're also adding more detail on investor asset allocations to show investors how much they're invested in single family homes, vacation rentals, and private credit, and potentially new investments that we have coming down the pipeline, and really be able to get an easier look at what an investor's current allocation looks like. We also love investor feedback on what you'd like to see next. So feel free to reach out in the chat or reach out to Arrive on anything that you'd like to see us prioritize over the next year, and always take that feedback into consideration. One of the big things that we've been working on now for really more than a year at this point is the Arrive secondary market. And investors may have seen the news today, but we're excited to announce that we're planning to launch the secondary market, allowing investors to buy and sell shares of our past properties on Arrived, and that's coming in this summer. So it'll create a quarterly opportunity for investors to buy and sell shares, either get liquidity on older investments that they may want to sell shares on, or buy into older properties, perhaps some properties earlier in our 2021 or 2022 vintage of properties, or some of our recent properties like the buyer's house that was a fan favorite on Arrived, and represents the property that was used in the filming of the TV show Stranger Things. We plan to have over 400 properties across more than 60 cities across the country for investors to buy and sell shares in. And this really represents the largest market of its kind. And so we've been working really hard to make sure that we get this right, that it's a great experience for investors from the start. And we've made a ton of progress on this, and excited to have a timeline for investors and when to expect it coming. And we'll be sharing more details about this as we get closer. And so with that, we can invite Cameron back onto the stage and open things back up for for Q&A and answer any of the questions that you have here live.
Fantastic. Ryan, Cameron, and Jake, thank you so much for prepared remarks. Jake's going to hop into the chat and answer any questions there. Again, they'll be performance focused for today, as well as roadmap, what we're looking at in the future. If you have more intro to arrived questions, those are best suited for our webinars that take place on Tuesdays and Fridays. But with that said, we will jump into the chats. I do want to say Ryan walked through what we released and what we have coming down the pipeline. We are building for and by each and every investor on our platform, new and existing. So feel free to keep that feedback coming in chat. You have the best people on our team reviewing all of that and taking it into account. So keep it coming. All right, moving back over, a quick one from Lauren, very timely. Ryan, you just walked through this. Will the secondary market set to launch this summer? Will that be applied to both individual single-family residential properties and vacation rentals?
Yes, this will apply to both single-family residential properties and vacation rental properties, and then new properties that Arrived is launching now will also be added to the secondary market in the future. So more to come on that, but yeah, that both types of properties will be added to the secondary market.
Fantastic. And a good feedback for us, Lauren. We can help clarify that in our communication moving forward. When we're talking about individual properties, those are typically inclusive of our long-term rentals and our vacation rentals, but we'll be sure to clarify that. A good one from Thomas, especially as we're looking forward. Cameron, I'm going to kick this one over to you. What is the maximum amount allowed for the private credit fund? I did answer this one, but I think it's good to talk about the future vision and what we have in place.
Yep, sure thing. So for any single transaction, or I should say that the maximum right now is monthly per investor. So that amount is $5,000. So you could make two transactions, say for $2,500 or any combination of 5,000, and then that will be the limit for the month. And then the next month you can invest $5,000. So there's not an account level limit, but there is a monthly transactional limit for the private credit fund. Now, this is a number that could change over time. So as we have more originators in our stables that we feel really confident about the loan supply, that $5,000 max could change to 10, 20, be lifted. But it's a tool to help us make sure that there's a balance between the demand versus the supply and kind of the credit quality of the loans that we're purchasing into the fund.
Fantastic. Awesome. Let us know if there's any additional questions there. If you navigate directly to the private credit fund offering page, you'll notice that we have that limit there. If we do make an update, we'll be sure to notify you. All right, moving back over here. I know we had quite a few questions on this. So if I don't capture everybody's name in here, know that it's inclusive. Long-term, we have about 17 single family homes with about 28th month ownership. I'm assuming that lease, all of the down from the share price except two homes. Any thoughts? Cameron, I'll keep to you.
Yeah, certainly. With share prices, there's a couple of different dynamics going on here that contribute to kind of the downward pressure that some of you may be experiencing right now, especially from a particular vintage. So those are leverage, whether the investment carries a long-term mortgage on it or not, property values in the market today, as well as just understanding some more mechanics about what we put into the share price. So first, I'll start with the idea of leverage. So we know that in 2022, interest rates went from about sub 4% all the way up to about 7.5% in the span of about 7 to 9 months. So it was a very aggressive increase, the largest in modern history. And that made financing properties quite expensive. So probably by the end of Q3, we had stopped putting that debt on the properties. And that was also probably a local maximum for the markets at that time. Our observation is that, certain markets moved up, certain markets moved down, but real estate prices from that point have been fairly flat across the board. So what that means is that the higher interest amounts cause vacancy to be very expensive. So to the extent that any of those properties have had a turn, not only do you have the operational costs of vacancy, you also have the interest expense that is continuing to tick. So that is a challenge when it comes to vacancy. But even if a property is occupied, one other impact of having leverage or long-term debt on a property is that it reduces the basis, which means it reduces the amount of investor equity needed to fully fund an investment. Let's say you have a $300,000 property. Normally on Arrived, we would raise about $350,000 for that property. There's a cash reserve, there's rehab money, there's other parts of it that, why we raise above the purchase price of the property. And then if you get a loan on it, let's say a 50% loan for $150,000, overall, you need less money than $350K. You probably only need $200,000 to fully fund the investment. So when your denominator is lower, then the cash impact of, really good results will make, or, the cash impact of good operational results will have a very positive impact on dividends and share prices. And then inversely, when you have expenses or vacancy, it can quickly drop the share price faster than it would be if it was unlevered, because you have that extra leverage in there. So I think that the 2022 batch of properties, those are tough because of that local max in the markets, plus the elevated interest rates. That's one component of it. The second is the property values. So I'd mentioned that they are flat when you look at it on kind of a multi-year basis. Q4 in particular, we started seeing much more softening. You can imagine that with interest rates above 7% for going on over 2 years now, the market is starting to get a little bit exhausted on the buying side. Anybody who could have gotten, who needed to purchase a property and can afford the 7%, 7.5%, that number is getting smaller and smaller and smaller as far as like who can afford that. And we have a publication that we rely on for research, John Burns Real Estate Consulting. It's one of the preeminent residential research publications out there. They're observing that the inventory levels of builders is creeping up. So in all their new home communities, the amount that is being delivered as new supply is exceeding the rate at which community or homes are getting purchased within that community. So that buildup of inventory is also another indicator of softening of price. So in Q4, we did observe that our property prices were down on an average around 1%. So that'll also impact the equity side of the balance sheet. And then finally, this is a little bit more of a mechanical consideration with respect to how Arrived prices its shares, but they're a fully burdened cost, meaning that any fees that are associated with sourcing and when we're capitalizing the investment, it's included in that initial $10 share price. So that is a component that represents revenue to Arrived, but it's not necessarily value in the property itself, right? It's so I say our share prices are a full representation, fully burdened of everything that you pay for, including future disposition costs. And I think that's important to note. And we think it's a very intellectually honest way of approaching your return potential. Because if you didn't include those disposition costs in the share price itself, if you have a certain share price representation and then the next day we sell the property, there are transaction costs of a 5-6% kind of market standard. So those are representative of real costs that are going to come out from the share price, because the actual cash and equity, you're not going to get all of that 6% back. So all that to say is that we fully burden all of our share prices to have a very honest representation of what the value is for the share. A lot of other investment companies, they'll charge the fee, say the equivalent of a sourcing fee, outside of the investment. So they don't couple them together. So if you were to buy a share for $10, you might then receive a bill for 35 cents for every share that you purchased. So you paid for that fee, but it's not represented in the share price. Whereas with Arrived, all of those fees and all of those future costs are also baked in. So it can be a bit of an uphill climb because of those additional costs that are baked in, but it's the reality that whether fees were in the shares or outside of share, that's the economic reality. So thought that would be helpful to go through the mechanics of what is in the share price, as well as impact of leverage, as well as kind of the vintage that is commonly referred to in the question, saying that you've held a property for 2 years, 2 to 3 years, how come the share price is down? Hopefully those mechanics can help reconcile some of the differences, but happy to answer any further questions you may have about that.
Absolutely. Thanks for walking through the different facets, Cameron. We also have this one from Mark, which is slightly aligned since you're talking about share prices. Do you have any additional commentary here?
Let's see. The strategy going forward to mitigate this. You know, the operations and getting to good cash flow is the best way to mitigate this. Part of it is how well are we operating such that we can minimize the expenses and keep the investment cash flowing for while you're holding it. The other part is having the kind of long-term view and patience to weather the storm in the market, such that when markets start appreciating again, then we have this cash flowing investment that we've been able to hold on to. And that's really the thesis of single family residential, is that it's a highly liquid investment that both owner occupants and investors desire. It produces tax advantaged cash flows, which allows you to stay in the game for as long as you need to be able to catch the good cycles. Real estate appreciation is not a linear trajectory. We think about it in kind of a linear way because we look past, 20-year averages and try to say, hey, it's 4%, but it's very lumpy. When real estate falls, it can fall very quickly. When it rises, it can rise very quickly as well, as we've also seen, from the great financial crisis where it goes down quickly, the pandemic where it went up quickly, and a lot of other times it's flat. So we need to be able to hold on to the investment long enough such that we can catch the wave that we want to, and then capitalize on the appreciation and sell the property. But the key to that is having good operations so you can stay in the game. So that's really the probably most accurate but generalized answer as well, is that the better the operations you have, the more optionality you have to hold on to the investment. And that's where we'll be able to get our returns when we can strike when the the investment is ready to be sold.
Absolutely. Yeah. Great questions. Appreciate you walking through it, Cameron. Jumping into a taxes question, very relevant, given that we just distributed 1099 DIVs last Thursday. We also hosted a taxes webinar. I know Jake has dropped that in the chat as well. Kevin had asked on the 1099 DIV, how come there were significant distributions classified as non-dividend distributions? In other words, return of capital instead of ordinary dividends, which would be considered income. Why return capital versus dividend? Brian, I'll kick it to you. Yep.
Yeah, I could take this one. And really, what you're seeing on your 1099 DIV is really one of the benefits of investing in the long-term rental properties and vacation rental properties. And what's happening is that depreciation, which is, an expense that offsets the rental income, but isn't actually a realized expense during the year. It's offsetting the taxable income for the property. And that means that for the vast majority of rental properties, the costs like depreciation are offsetting the distributions. And so then that way it's showing up as a return of capital instead of a dividend, which would be taxable income.
Fantastic. Awesome. Let us know if there's any other questions there. We also have that taxes webinar. I believe it's linked in there, but we'll drop it again to reference. All right, let's move over here. Oh, a good one. Very timely. I know we asked for some feedback in chat. I'm sure you'll both have feedback and thoughts here, but I'll kick it to you first, Cameron. Any plans on purchasing commercial properties? In chat too, we would love to hear what cities that you're interested or markets. So have that coming our way. And Cameron, I'll kick it to you.
Yeah, so I think the short answer to this is currently no. I think that there's nothing that precludes us from investing in commercial properties in the long run, but we're really focused on residential-based investing right now. So with single-family residential, vacation rentals, private credit, where the underlying assets securing the loans are also residential assets, that is really our bread and butter and where we have developed the most competencies as a company. Commercial real estate is a very different exercise and ballgame than residential investing. And I think that we're not quite yet at the size and team resourcing to confidently go into commercial investing. I do think that there's good opportunities, especially with the market being a little bit distressed. There could be some good opportunities in the upcoming years to capitalize on commercial, but it's a huge market. It's filled with a lot of institutional money. So it's also a very kind of dangerous game to play too, because these assets are extremely illiquid, and the competition pool is also, very sophisticated, deep pocket type of entities. So we feel very comfortable being in residential. We think it's the place to really build our business model off of, and we're going to continue to do so. But there's also kind of hybrid varieties of commercial. So for example, you could look at mixed use properties, where it's very common in larger metro cities, densely packed cities, to have a pizza place on the first floor and a convenience store, and then above it there are condo units and apartments. I think that could be a possibility, and they're becoming increasingly popular. Cities have a motivation to both provide resident housing as well as increase their tax base, so they kind of like that combination of revenue coming in through businesses, but then providing housing right above it in kind of a convenient way. So I do think that something like that could be very interesting. But pure commercial properties, that is, adjacent to what we do. But I would say that there's a lot more investing that we need to do internally before we go over there. And the single family residential market and the residential market in general in the US is just so large that we think we still have a lot of other good opportunities to get into before we focus our efforts on that.
Absolutely. And it was very timely, and you touched on this, Cameron, but Javier asked it almost simultaneously. What are your thoughts on residential apartment complexes that focus on residential? I know you briefly touched on it, but I'm curious the vision for the rest of 2025 and beyond.
Yeah, multifamily in general is definitely within the competencies of what we do. The operational components of it, as far as landlording, collecting rents, investing in residential units, perfectly in scope with what our team does. It's more of an order of operations. So I view multifamily as an area, as an eventuality, and it could be sooner than later. What is probably closer in time is small multifamily, so a 2 to 4 unit type equity investment, and then you graduate to the 8 to 10 units, and then eventually you can graduate to more of the 40 plus unit city block, larger apartments, on-site managers. So those start getting a little bit different than kind of scattered site like we've been traditionally operating in, but nonetheless it is residential, and I think it's a function also of which cities do you end up in. So we've largely focused on the Southeast, the Midwest, and kind of the Southwest parts of the country. Single family residential is, the asset of choice in those markets. But as we expand to coastal areas, multifamily starts becoming that predominant way that people are consuming housing. So it's definitely within the strike zone of what we would be doing. I could see us getting into some small multifamily in 2025. It's not a given, but it's also not off the table. It really depends on the market demand, the opportunities for multifamily, and the next geographies that we get into.
Cameron, I thought it was also worth adding that within the private credit category, if something like multifamily is something we're already really participating in on the credit side. And that, part of it is market timing and whether we think we want to be on the credit side or the equity side. But that's one way for investors to access multifamily investments right now.
Yep, that's a great point. Thanks for bringing that up.
Absolutely. Yeah. I'm curious too, because I think there was a second part. Ryan, you had mentioned we're in over 60 cities today. We're north of 400 properties for all individual. That's not inclusive of the SFR fund. Cameron, do you have an idea if we'll be expanding to more markets in the future? Do you have your eyes on any in particular?
Yeah, we do have our eyes on some new markets. One of them is Las Vegas. It's a market that our team knows really well. In fact, we have a couple team members that live there. I used to live there. We think it's a great market. I think that there's a lot of kind of reshifting population dynamics where some people are leaving California, or they're getting to kind of a retirement age and they want their money to go a little bit further, kind of cash out in the real estate that they've had in California. So Vegas has been a popular destination for that. So we're bullish on its continued growth. We're looking to continue expanding in Salt Lake City in the Utah market. There's interesting opportunities in Dallas. So, we do have a property in the single family residential fund in Dallas already, but, Texas is a great market, strong economy. So we're looking to expand further there. I'd also say that within our existing markets, we're also looking to mix up the assets, and where we invest in. Largely, we've invested in second to third ring parts of the metro area where there's new inventory and lower, more affordable price points. That's a heavy concentration of our portfolio. So we're looking to start sprinkling in and stepping up in neighborhood. We have a really great portfolio that is, lower cost basis, newer assets, good rent ratios. We want a little bit more exposure to the neighborhoods that can really take off because it's more affluent. Because as interest rates start coming down over the next couple of years, we want to be positioned to take advantage of the kind of high demand for those neighborhoods. Because when those rates come down, affordability goes up, and higher income earners, they're going to want to pile into those more upscale neighborhoods. So, our core thesis is still very much new inventory, strong cash flow, and, path of progress. But this is more some portfolio blending to get exposure to the next tier of neighborhoods in the cities that we're already in.
Absolutely. Javier seems excited about expansion in the future. Definitely keep it coming our way. I know we also have a very active subreddit. Feel free to leave feedback there. You can email support@arrived. You can use our chat function in the bottom right-hand corner of our platform, but we love to see it coming in the chat. So keep it coming our way. Cameron, you mentioned Texas in particular. I know that was obviously a state, but various markets that we've heard over time that folks really wanted to have the opportunity to invest in. So we're very excited when we released that into the single family residential fund. We've also heard folks that want to have be able to invest in properties in which they reside as well. So more to come. I know Seattle's near and dear, but there's a lot of different details that go into choosing markets and investing. So more to come. All right, moving back over. A good one from Bill. Will an older property that might be close to selling due to market conditions and appreciation be restricted from being offered on the secondary markets? Ryan, I'll kick it
I
to
can
you.
take
Yep.
this one. So we may restrict or not include a property in a given trading window if we know that the plan is to sell the property. So for the most part, each property should be trading, and available in each trading window. But yeah, if we have a plan to exit or sell the property, then we'd likely look to not include it in that trading window while we list it.
Fantastic. Awesome. Definitely more details to come on secondary market. So feel free to continue to ask those questions. All right, moving back over here. Let's see. Oh, a good one from Mark. This might be a little bit more in the weeds than what we have prepared right now, but a good one to walk through nonetheless. For a long-term rental, what state has offered the biggest upside surprise? Cameron, do we have this one offhand?
Well, from kind of I thought I kind of interpreted this question as more of a what will be kind of the surprise of the state that has large upside. And to me, there's two states that come to mind. One of them is Tennessee, and the other one is Arkansas. And Tennessee has an extremely good cost of living, very good tax regime, pretty place to be. It's kind of there's a funny saying about Tennessee I heard before. It's the furthest south that Northerners will go, and it's the furthest north that Southerners will go. Kind of the conventional wisdom there is that it's got a strong magnet for the population now, both culturally as well as kind of quality of life point of view. So there's a lot of markets that we're investing in Tennessee that we're really bullish on. And Arkansas is also one of those names that, is maybe it's not at the forefront of your mind when you're thinking of, states with really strong upside, but the economy in Northwest Arkansas is absolutely popping off. And we have a lot of team experience there as well. A lot of people from that area that can really corroborate that. So I would look to those two states, and it's kind of reflected in the portfolio. We do have heavier concentrations in both of those states relative to how large of a state that they are. But that's where we really like the long-term rental dynamics, as well as all of the more the macro factors that will encourage property price appreciation. So we had some strong bets on that market. We're confident that it's going to play out over time, but those are the two markets two states that I really like.
Thrilled to hear. Yeah, couldn't be more excited. I'm glad you interpreted the question differently than I did. And for everybody's patience with my chief barking officers, I think there's deliveries happening. So I'm going to be in and off of mute here. A good one from Vishal. I love when we're thinking big here. How do you envision the private credit fund performing in 2025 and beyond in the light of potential Fed rate cuts and lower Treasury yields? One note I'll make here is this is not a research report or investment advice, so all information we're sharing is not predictions for the future. But Cameron, would love to hear your thoughts, and Ryan, if you have any commentary as well.
Yep, we think private credit is going to continue to perform strongly. I think that my observation is that within being in the lending world for quite a while when it comes to the space, which is called RTLs, residential transition loans, but it's the generalized name for construction loans, bridge loans, and fix and flip loans. I've been pretty active in this business for about 14 years now. I've largely observed that the rates being offered to the borrowers and kind of what are the going rates for those types of activities have largely been decoupled from Treasury yield curves and kind of risk-free curves. And when I say risk-free, I mean, there's U.S. Treasury bonds, is that whole yield curve from 1 month all the way out to 30 years. That's the risk-free curve that I'm referring to. So there's also a lot of different segments within private credit itself, within the RTL space. Fix and flips, they are different than bridge loans. Bridge loans are, we like them because a lot of the riskiness is kind of mitigated from it because there's not usually any sort of value add activity going on like a flip. There's, a fair amount of construction risk if you are doing a flip and you own a loan from an inexperienced borrower. So I say that an inexperienced borrower is one of my kryptonites for the private credit fund. So we really try to keep all of the inexperienced people out of it. You could have a really great borrower who has a lot of good experience. And if they have a marginal project, they'll usually make it work, or they have the assets to bridge the gap and make it work. You could have an inexperienced borrower who has a really great project, but if they're inexperienced, there's still a reasonable chance that they're not able to execute. So within those private credit segments, we're really optimizing for strong borrowers. And we like ground up construction as well because those rates tend to be a little bit higher. With all of that construction, there is more risk in it. But with that said, we skew towards super experienced borrowers and not just kind of the hobbyist that has done 3, 4, or 5, flips over the year or two. We're talking people that do this for a living, who are doing 20 projects a year that are breaking ground and, buying large swaths of land, doing a lot of value add, super experienced people. So I think that, the private credit fund, I haven't seen much softening in the market yet. That's not to say that yields may not chase it down a little bit, but just over a long period of time, I haven't seen a ton of correlation between the rates being offered within the RTL private credit space versus the risk-free curve.
I'll also add that if we think about residential backed credit in general, we have a lot of plans for that at Arrived. I think we're still early in what we can do with residential credit. And in general, I think we just view it as a great complement for residential equity investments. So for investors who are interested in building a diversified portfolio and diversifying into different types of investments, credit and equity investments are oftentimes less correlated to each other as well. So anyways, there's a lot I think that we have planned in how the credit category can grow on Arrived. So some more to look forward to there too.
Absolutely. Very excited. Great questions in the chat. Very much appreciate it, Vishal. Moving back over to the queue here. I know we're getting close to the top of the hour. We have a couple more in here. It looks like Steve had a similar question. This is Steve C. Great to see you here today. We always appreciate your engagement. Cameron, any more to add here? Do you anticipate the 8.1% return on credit fund to be maintained in the near term based on what you're currently able to do with loans, realizing it can change? I know you both walked through those details, but just to double down I think we were looking long term. Now this is a little bit more short term.
Yeah, I think in the near term, we'll continue to maintain that. I have line of sight into what our loan pipeline is, and I think there's a lot of high quality loans that are at rates that'll allow us to continue delivering the yield targets. But if I go back also to one of the um, points that was mentioned, about the $5,000 max, what you're pointing out, Steve, is really the reason we're also trying to we're putting on the max is to make sure that we can accumulate the loans that are both um, not de-risked, but like good risk return ratios, and that we can meet that 8.1% dividend yield on the credit fund, because we really want to be able to maintain that. But we also don't want to risk future defaults and foreclosures as the way to get that. So, we've metered it in order to continue hitting that yield, building up the originator base. But in the near term, I do expect that we'll be able to maintain it.
Absolutely. Wonderful. I just have to say too, I so appreciate everybody's questions in chat and the engagement that's taking place for the last 58 minutes is absolutely exceptional. And to our team for jumping in on all those questions. So thanks for the kind words that I've seen in there, David and Javier. And we will move back over here. Another good one from Javier. Does the team expect any drastic changes under the new Trump administration? Just seeing how Arrived is doing. I'm seeing the trade wars could increase costs for lumber or wood. That'll mess with house prices. I think we had quite a few folks that were curious about this in chat. Obviously, and we're in real estate, so it's very pertinent. Cameron, I'll kick it over to you. And then Ryan, too, if there's any additional feedback there as well.
Yeah, I think the way that a new administration could impact real estate at large across the country is through housing and urban development. So, generally a Republican base is going to be a little bit more in favor of deregulation, letting kind of business activity just happen. So I don't think that there's anything drastic that we would see. And I don't anticipate that the administration would put anything on too restrictive that would hamper our abilities at a national level. Real estate law is largely a state governed subject, and that makes sense because real estate is a function of land, and it's very specific to local and state laws. So ultimately, you're not going to have too much volatility or change, because even if you wanted to enact something at the federal level, there's still state and local norms and legislation that is another layer on top of it. And that is largely what controls the dynamics of landlord-tenant law, is still at that state level. So, not to say larger changes couldn't be in the works. And, credit policies also start coming into play here, underwriting policies. There's so many other things that could impact kind of in an indirect way the retail consumer and the real estate markets. But I also do kind of index to the fact that real estate is state and local driven from a regs and rules point of view.
Fantastic. Awesome. Some kind words, Lydia. Thanks so much. And Roy as well. So appreciate you being here. I know we're just hitting top of the hour. I think we cruised through most of the questions. There was just one more in here from Steve, which is a good one. If you did redemptions on the private credit fund, the redemption premium would be based on assuming you are redeeming oldest dollars, lower premium first, presumably. Ryan, I'll kick that to you.
That's correct. Yeah. When you make a redemption out of the fund, you'll be redeeming your oldest shares first.
Fantastic. Awesome. I think we cruised through most of the questions here. Vishal, I know you had some feedback on a referral program. We had explored a lot of that previously. It could be something that we offer in the future. I believe Alexa asked too if you would be interested in a merch referral. We have some barriers with Reg A when it comes to incentivizing with dollars. So we so appreciate that feedback. Ryan, if you have any other details on that as well before we jump. Awesome.
I was going back and forth on the mute and unmute. Yeah, no, we really appreciate the feedback, and it's something we continue to look into. Within the investment space, there's a lot of considerations just to make sure that it's in compliance with the regulation. And so that's what's restricted us up to this point, and why we don't have one yet.
Awesome. Great feedback. Keep it coming our way. I realized there was one earlier, Cameron, that I'll kick to you before we shut our virtual doors here. David had asked, what is the target LTV on the private credit fund?
Yeah. There's not an LTV target at the fund level, but there are more so constraints and underwriting standards at the loan level. So LTV stands for loan to value ratio. And there's a couple different measurements of this within underwriting, depending on what stage are you talking about. Usually in the beginning, there's two different types of loan to some sort of value calculation. The one is loan to cost. So, would we finance somebody more than 100% of what they bought a property for? Likely not. That's probably not a good loan, because usually you want to see some skin in the game from the borrower. So they need some equity capital. So you definitely wouldn't want to do that. Now, with that said, loan to cost for the fix and flip segment, industry norms are starting to push 90%. We try to keep it below 80%. And that's not to say that we haven't ever done a loan around the 90% range. For example, somebody could have gotten a really, really good deal. And when they get a really good deal, their cost basis is low. So there's a delta between market value of what they bought and cost that they paid. In those cases, when there's a big gap, you should be willing to come up on the loan to cost ratio, because the actual value is like, you wouldn't want to necessarily punish a borrower for getting a good deal. The other is on the back end is loan to after repair value, LTARV. And this is one of the main metrics that people underwrite for, that when it's in its final form and completed project, an appraiser goes through and they say, this is what we believe the after repair value to be. We don't set it ourselves. We go off appraisals and then we verify it. So, we look at, on every single one of our loans, the appraisal report. And if we disagree with it, we're not going to necessarily use that value as the denominator of calculating LCARV. We'll reevaluate it at the value we think it is. Generally, that number is going to be below 75%. So you want at least a 25% cushion in what your loan is today versus the value of the property in the future. So that's probably the instructive ranges to that. We try to be below 80% when it comes to loan to cost. So we don't want to loan more than 80% of what somebody paid for an asset. And then by the end, we don't want to be lending more than 75% of what the final value will be.
Fantastic. David said great, makes sense to me. So always appreciate you walking through it. Ryan, one last one on feedback that we're seeing in the chat, because it's a little bit of a raving review there for Auto Invest. So I'm curious what your thoughts are. Maybe we walk through what that blocker is to date.
Yeah, so the ability to auto invest is definitely something that we would like to build for investors, and we get a lot of feedback on that. There's really kind of two ways that I think people envision it. One is auto reinvesting their dividend distributions. We think that at some point that's likely possible within the funds. The challenge within individual properties is that they can't be auto invested into the same property. Investors would like to allocate them to new properties or new investments. So that's something we've been thinking through. And then long-term, just auto investing in general, being able to say, hey, I'd like to invest a fixed amount every week or every month into, these types of investments, is also something we're considering. There's some additional regulatory licensing that we need to get to make that happen. And so that's why we haven't done it yet. But yeah, all of those things are, certainly something we're thinking on our roadmap.
Absolutely. Definitely appreciate you walking through it. Great feedback in the chat. We'll be sure to share with the team, but everybody from the team is here. So we definitely appreciate you all sharing that. Cameron and Ryan, any closing remarks before we shut our virtual doors today?
Well, really appreciate everybody's attendance and thoughtful questions. We really enjoy doing these every quarter. So we got some other great webinars coming up specific to property management process. So look out for the scheduling on that. But I think 2025 is going to be an exciting year. So good way to close out 2024 with the Q4 results, and looking forward to what's coming this year.
Yeah, thanks everyone for joining the webinar today, for all the great questions. for our team, and Cameron and Korin and Jake, thanks for helping us lead the agenda today, and Arrive team in the chat, thanks for helping us answer and tee up all of these questions live. So thanks again, everyone. We'll see you soon on the next one.
Absolutely. Cameron, Ryan, and Jake, thanks again for so much for prepared remarks. For our team in chat, you're absolutely exceptional. The engagement here for, what is it, 11? It's 11:07. So over an hour is absolutely exceptional. If you have any other questions, feel free to reach out to support@arrive.com. You can use that chat function in the bottom right-hand corner of our platform, or respond to any and all emails. We're live on all social channels. I'll say the one that's most community-based would be our subreddit, so feel free to jump in there. But I hope you have a great rest of your day and happy investing.